Did you know that consumer sentiment can swing drastically due to just a couple of staple prices? As the costs of orange juice and eggs drop, could this shift in perception spark broader economic recovery? Learn how these seemingly small changes hold the key to unlocking consumer confidence and influencing inflation. Don't miss out. In the ever-evolving landscape of economic sentiment, the recent fluctuations in consumer prices for staples like orange juice and eggs serve as a poignant reminder of the intricate relationship between market dynamics and public perception. Historically, consumer sentiment has been a bellwether for economic activity, often swayed by the prices of essential goods. This narrative unfolds against the backdrop of a tumultuous economic period marked by the aftermath of natural disasters and health crises. For instance, the citrus greening disease that has plagued Florida's orange crops has seemingly been contained, leading to a dramatic decline in orange juice prices, nearly 50% in recent months. This recovery, coupled with the easing of avian flu impacts on egg production, has resulted in a decrease in egg prices, now hovering around $5 per dozen. Yet, while these price drops may evoke a sense of relief among consumers, they are unlikely to significantly alter the broader inflation data. The contrast between the optimistic consumer outlook and the stark realities of inflationary pressures highlights a systemic issue: the disparity between elite economic narratives and the lived experiences of marginalized stakeholders. As experts have noted, consumer sentiment can be a double-edged sword. While it may improve with lower prices, the underlying economic conditions often tell a different story. This pattern recalls previous economic recoveries where superficial improvements mask deeper systemic flaws. Paradoxically, as the market grapples with the implications of tariffs and trade wars initiated during Trump's presidency, the current correction, down approximately 9% from its peak, mirrors the volatility of that era. Investors are left to ponder: are we witnessing a mere technical rally, or is a more extensive corrective process on the horizon? The Federal Reserve's upcoming meeting looms large, with no rate changes expected, yet the market remains vigilant for any signals that could indicate a weakening economic outlook. Will the anticipated retail sales data reflect the resilience of consumer spending, or will it reveal the cracks in the facade of economic recovery? As we navigate this complex landscape, it is essential to remember the lessons of past corrections. Were the actions taken during previous downturns the right ones? If not, how can we avoid repeating those mistakes? The volatility we experience is the price of investment, yet it is the behavioral impacts of this volatility that often dictate our outcomes. As we look to the future, the question remains: can we transform these economic structures to foster a more equitable system, or will we continue to be ensnared by the very forces that perpetuate inequality? The historical parallels are striking, and as we reflect on the current state of the market, it becomes clear that the path forward requires not only vigilance but also a commitment to systemic change. In my view, the current economic landscape reveals striking systemic injustices that often escape mainstream discourse. The dramatic fluctuations in the prices of essential goods like orange juice and eggs could be seen as mere anomalies, but they highlight the precariousness faced by marginalized communities who still grapple with the scars of inflation. It is evident that the decisions made by the powerful elite often disregard the needs of these vulnerable populations. The question we must ask ourselves is: how long will we tolerate a system that prioritizes corporate profits over the well-being of the countless souls struggling to make ends meet in a volatile economy? S'escribit y dale like para mantener informado.